What's going on, guys? Welcome into Energy News Beat here on this gorgeous Friday, January 29th, 2021. As always, I am your humble correspondent, Michael Tanner, coming to you from an undisclosed location here in Denver, Colorado, joined by the executive producer of the show, the purveyor of the show, and the director and publisher of the world's greatest website, EnergyNewsBeat.com, Stuart Turley. How you doing today? It's been a long week, my man.
Oh, it is. It's a beautiful day in the neighborhood, and I'm just here in an undisclosed location in Bear Country.
Yeah, you can do that. You can check out all that in a bag of chips on the show to my left here. But first, guys, thank you for subscribing to the show. If I was a 16-year-old YouTuber, I would scream, smash that like button. But I will not do that. I will refrain from that and just say, please subscribe, hit that pesky notifications. But the best way to stay up to date on all things Energy Newsbeat. Also, check out our website, EnergyNewsBeat.com. If you just need an IV of news like I do, hit our notifications button in the bottom right. It's a little red, much like my shirt bell. It's literally a stream of consciousness news. It's almost as good as an IV of coffee. Check it out. As we look at the equities markets today, I'll just start with top line numbers. Not a good day. It's a lot of red today, folks. SPY was down 1.9 percentage point. Nasdaq tumbled over 2 percentage points. Dow Jones tumbled over 1.9 percentage points. Yesterday we saw the same sort of fundamentals happening. GameStop, all of these, Robinhood, we all know that's going to happen. We're going to talk a lot about that with DRW coming up here in a little bit, so I would stay tuned for that. He's coming up at the end of the show. But really on the equity side, what you're seeing is, here's the quote right here. There also feels that GameStop is a sign of a larger bubble in the market that is unraveling and could cause turbulence and hit retail investors hard. That's a quote out of JP Morgan. A number of lawmakers last night and this morning called for an investigation into the chaotic trading. Elizabeth Warren sent something to the Securities Administration. So it's going to be very interesting. We'll talk all kind of what happened. GameStop, like I said with DRW, my take on the markets right now is you better just get long, because that's what's happening. Yes, we see market pullback here, but who knows? We're gonna rest. No rest for the weary. Monday will turn around. I'm just interested. Some of the underlying fundamentals, like I said, aren't still terribly good. But GameStop, as I mentioned, was still up 60%. Robinhood having liquidity issues. They raised $1 billion from existing investors overnight to sort of stay out of this liquidity crunch. It's pretty crazy seeing their CEO have to, emergency press conference on CNBC is never something you want to see. Here we go. Here's chief market strategist Miller Tabak. At Miller Tabak, Matt Maley. There's way too much leverage in the system. We are starting to see signs of this excess leverage is going to be unwound in ways that will create headwinds for the stock market and other risk assets for more than just a few days. It'll be very interesting. On the coronavirus vaccine, new trial results from Johnson & Johnson was slightly disappointing. It only was 66% effectiveness protecting against COVID-19, 72% effectiveness in the United States, 66% in Latin America, and 57% in South America after 4 weeks. Shares of J&J dropped 3.9 percentage points. Moving over to the crude oil side of things, is down about 0.3 of a percentage point, 52.17. We were all the way up at a market high of about 53.25, coming off an increase of rig counts plus 6. We tumbled late afternoon just off again. Some of this COVID-19 news. We were really hoping, the distribution is what's really bogging prices down right now. And hearing that COVID-19, Johnson & Johnson disappointing some investors, it's going to bring prices down because we're going to cover here in a little bit with some of the crude oil demand. Things are getting cut, Stu. That $60, $65 a barrel might be a little too pricey or a little too high, much like natural gas. Back into the curve for crude oil, down to $50 even. That's 0.3 of a percentage point. Natural gas, as I mentioned, did not have a good day, down 3.8 percentage points, $2.56. Part of the reason we're just back into a little bit of a warmer trade. That cold front we saw moving in, well, it's completely warmed up. At least today, Denver's been great after having 2 days of snow. But really, that 5 to 7 day outlook is starting to turn just a little cold or warmer, so that's partly why you're seeing stocks drop on that front. Moving down into XOP contract, down 3.6 percentage points. Got pounded today. Only about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 stocks out of my 137 that I track here for the show finished positive. So we're going to see a lot of red numbers in the downside. OIH, which are oil field services, down 1.5 percentage point, 162.59. For all of my crazy traders out there, Dogecoin up 61 percentage points, currently trading at 0.053 cents on the dollar. Let's go ahead and scroll up on some some of our biggest equities, winners and losers. U.S. I mean, holy smokes, dude. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 companies that were down at least 25 percentage points. Yikes! Or as we like to say, double woof. Houston America Corporation, they're down 25 percentage points. U.S. Energy Corp down 28. Camber Energy 33. Texaco Gas down 41. Barnwell Industries down 42. And our friends at New Concept Energy, after being up 1,000 percentage points, falling back down 50 percentage points, 11. Let's go ahead and move to the upside here. A couple top line numbers. Extraction back trading, they're up 0.7 of a percentage point. Prime Energy Resources, 2.3 percentage points in the upside. Telrinian up 6 percentage points, and Next Decade Corporation up 6.8. Stu, last day of the International News Desk. Not as crazy as it has been, but it's been a pretty wild week.
Oh, it's been a brutal week. We got more coming up next week. Last week I predicted some things going on. It's been pushed out to next week. We got some really wild stuff. Hey, this one, I got my first story here with natural gas in peril, with the Biden administration axing the Keystone pipeline and also all the jobs. Here's another one that's going on. We have pipelines. Now, I'm big on hydrogen. You keep beating me up about this, but all these pipelines are in the ground, and you have said it many times, Michael, we are not going to get too many more pipelines. So that being said, this article that we put out is there are 3 million miles of natural gas pipelines in the U.S. There's even more around the world where a lot of this is addressed as well. Hydrogen can be burned without carbon dioxide. It can be transmitted in natural gas pipelines.
Hydrogen running through the pipelines.
And all you got to do is put a pig in some of them, and then run some new sealant in there, because hydrogen in unsealed pipe will erode the pipe.
Yeah.
So the pig business is going to be going really big. Not the pig that you eat, but the commodities in technical kind of thing. So big news. Let's keep watching for hydrogen. I think it's going to be a big.
Hydrogen's big. I've been involved with the project. Top secret, but trust me, hydrogen's on the way. It's coming.
You bet. And I think it is. That's a big one. Here's one that really is an unsung discussion regarding world oil prices. Let me read the headline. Biden advisor warns escalation of nuclear crisis with Iran. How will this impact world oil is a good question. All right, backing up, I'm older than dirt, but yet I can remember the former administration of Obama and Biden when they actually signed the nuclear deal. And then they dropped off over $1 billion in a airplane, kicked off $1 billion in cash, which is unheard of. They got the treaty signed, and then Iran still was pumping out uranium for nuclear weaponry. So here's my question. Iran is going ballistic with pumping out oil because they need the cash. They're spoofing, they're doping, and they are the critical piece in OPEC's missing puzzle for the oil pricing. Mm-hmm. How much is this going to cost the U.S. this time in order to enter into this nuclear deal? And the second question is, how are they going to take a look at how all of this plays into the world market? So this fun little issue is actually bigger than what anybody's thinking. So anyway,
it's huge. You've been on this stuff. It's interesting to see. We're back in the it's just funny to see the Biden administration warning. Where were you the last 4 years worrying about this? So
and I took exception to the bottom part of that article, Michael, when they said actually it only happened under Trump's watch that the additional refining of uranium happened. It happened within hours. Yeah, it happened within hours. So I think the Biden administration is doing some good things and they're running around, but I think that they missed the boat on this.
Can I quote you on that one, Doc?
Absolutely.
And thank you guys. All of that courtesy, the world's greatest website, EnergyNewsBeat.com. Stuart Turley coming to you with the International News Desk. As we move over, I got four things I want to cover here. Quickly, rig counts +6, Canada +2, as I mentioned, U.S. +6, international actually dropped 4. A lot of that actually came back in the Permian. We saw one rig here in the DJ, so good to see. Speaking of President Biden here, he's got some ambitious plans to take on climate change, and on Wednesday he actually unveiled an interesting one. The next thing involves FERC. So if you don't know what FERC is, it's the Federal Energy Regulatory Commission. They're a 5-member organization. They're poised to play a pivotal role in fulfilling all of these clean energy ambitions, including, and here's the key, his vow to strip greenhouse gas emissions from the power sector over the next 14 years. Here's the quote from the president himself: "Transforming the American electric sector to produce power without carbon pollution will be a tremendous spurt of job creation and economic competitiveness in the 21st century." Why I bring this up is there's the sleight of hand that's happening. And I want to explain. There was a sleight of hand. Remember when it was climate change? Remember when it was global warming and now it's climate change? There was the sleight of hand that they changed. Well, they just needed to cover their bases. We need to make sure. Well, here's what we have here. It used to be we need to be solar, like the last 3 to 5 years, and let's see, in the Obama administration and while President Trump was in power, what was the term? We need to produce clean energy from solar, wind, and hydrogen, or whatever it was. Well, now look at the sleight of hand that he did here. Transforming the American electric sector to produce power without carbon pollution. Well, guess what? You can produce oil without carbon. So the sleight of hand, it's happening. This is how it happens, people, right before our eyes.
Now, there's another article we just ran on the news desk for this one. Biden was quoted as saying he's leaving coal in, and he's also recommending nuclear. So all of a sudden, wind, solar, and coal, that means somebody got to him from a coal miners union as well as nuclear. I thought that was kind of interesting in that thing. Whoops, wait a minute.
Yeah, it's just watch the sleight of hand. It's going to go from we need solar and electric to no, we just need no carbon, because they're going to realize, wait, we can produce natural gas and we can have carbon capture on all of these wells. Yeah.
I'm big on nuclear.
No, you're all about it. 2 earnings we have to cover here. First, we'll cover the smaller company, CNX. Speaking of natural gas, they had fourth quarter, there's the Marcellus operator, had fourth quarter revenues of 625, beat Zach's consensus of 385. That's up 62%. Top line increase, 23.2% from a year ago. So good on them. As we look at the way they've traded up, though, they only traded about a quarter of a percentage point on the upside, which is really good comparative to the fact that the entire market, as I mentioned, was down about 3.6 percentage points on that one. The other one we have is Chevron here. Not good. They were down 4.29 percentage points, so you understand how the street saw that. They reported a net loss of $665 million, or about 33 cents a share for the fourth quarter of 2020, compared to about a $6.6 billion diluted loss in the fourth quarter of 2019. So they did a little better than 2019. Remember, they wrote down assets in 2019, so just remember that. They reported a full year loss of $200 in 2020 of $5.5 billion, or about $2.90 a share, compared to earnings of about $2.9 billion in 2019. Included in 2020 were some net charges for special items, $4.5 billion. Listen to this: foreign currency effects. So what happens when you operate in multiple countries? Well, you have to get all of your money into certain currencies, and that. Well, because of the currency markets this year, they lost $645 billion. Woof. Hey, Chevron, I'll help you. We'll do some currency trading for you. Hedge all of your currency for you. Just give me a call. Michael, sandstonecg.com. Hit me up. All right, final story we got to cover here. This is actually one I stole from Stu. He was going to run this on the international side, but I swiped it from him because I think it's a good idea of global oil forecast. S&P Analytics went and actually cut their 2021 oil demand forecast, and they raised their price outlook, which is interesting because I don't really necessarily agree with that. Global oil demand, according to them, will rebound by more than 6 million barrels per day in 2021 and return to 2019 levels a year later, despite the sharp acceleration in the COVID-19 infections. Oil demand is expected, according to them, to average 99.3 million barrels per day, following a contraction of an 8.8 million barrels in 2021. They also said that there will be a down. They did revise their 2021 forecast downward about 280,000 barrels. But Stu, you mentioned something interesting about the price forecast, both from Goldman and UBS. What do you think?
Well, Goldman is saying about $65 for Brent, and UBS was saying about 60. And I think that those
Barclays has got it at 55.
Yeah, and I think it's a little bit still high because we have some serious problems going on with OPEC supply. I think world demand and production is going to remain flat because we don't know how much is actually being produced. So I don't know that we're going to see $60 oil, and let alone $100 oil.
Yeah. I think this goes along with my natural gas price. But we spent about 15 minutes here, guys. I'm going to go ahead and toss it over myself. Introduce our boy, DRW. Well, first, David, again, thank you for joining us. Excited to have you back. It's kind of funny. We're an energy news show, but the first question we have to talk about is the thing everybody is talking about, Robinhood, GameStop, and all that's happening sort of in the world of investing. So I just kind of want to tee it up to you right now. Give us the rundown. It's been a crazy week. For those listening, we're actually recording this at 8:30 a.m. here on Friday, so the market's just opened. GameStop's up like 60 percentage points, like 314 right now. It's been an unbelievable week. Give us a rundown of what's happening, because you usually tapped into this stuff.
Yeah, so the GameStop one is a pretty interesting example. The key about GameStop, there are some others, but GameStop in particular, there were some hedge funds that were not only short the stock of GameStop, but they were short more than 100% of the outstanding float. So if, for example, if there was 10 million shares, they were short 15 million shares, which meant there weren't enough shares in physical existence to be able to fulfill the fact that they were selling the shares. And a group of traders and just retail guys found this out. And so they went to the Reddit boards called Wall Street Bets and effectively just rallied everyone to go and buy GameStop. So as you buy GameStop, it drove the stock higher, but these guys are sells short. And so the banks would call for margin calls, and on and on and on and on and on and on it went. And GameStop went from about a $20 stock in November to peaking north of $400 a share yesterday. Now, the key is the business is not that this is pure gambling, and it's called a short squeeze. And so the more shocking thing was not only did the hedge fund Melvin, which does its trades through Citadel, as I understand, and Citadel is an investor in the Melvin funds, they gave them $2.75 billion to bail them out. Then Robinhood, who clears its trades through Citadel, was effectively told, you're not allowed to let people buy stock, which is the same as like shutting the barn doors and letting the hedge funds reposition. So the retail investors went bananas yesterday. The stock fell because there could be no buyers. Then Robinhood reversed course because clearly there will be lawsuits. And now investors are back in and they're hammering. So it's crazy. But this is the state of the world. It's now a casino banana republic in the stock market with lots of illegal and shady stuff going on. It's and the Fed still has not yet intervened. Politicians are like flapping their lips, but they're missing the root cause. The root cause is the economy is not open. People are working from home. People have Robinhood accounts and are just gambling like crazy because they don't have jobs. It's insane. Welcome to America.
So what do you take of, because it sounds like, if you watched the CEO of Robinhood, he had, it's really bad when you have to bring in Andrew Sorkin at night just to cover a 10-minute interview with your CEO because your PR is going so bad. It just sounds like they were in a liquidity crisis. It sounds like if they didn't shut it down, people who had bought stock weren't even going to be able to get paid off it. That's what I think. Is that the latest update?
So the issue was because the hedge funds, the New York hedge funds were losing billions because they kept driving the stock up. And they're really, because they were so short, there is no way for them to get unshort. They're short more than the float. Okay. And so investors can just keep buying the stock up to 50,000 a share. That's not investment advice. That's just what they could do. And the hedge funds have to keep buying it. So the hedge funds are then going to be caught in a bag where they own all the stock of a company that's worthless.
Okay, that makes a little more sense. Well, it's
So
pretty wild
they
what's
don't
happening.
want that. So then everyone was on CNBC yesterday telling people how bad it was. This is just horrible risk management. That hedge fund was naked short more than the company. And quite frankly, they deserve to get their face ripped off. The fact that the banks were interceding to prevent that from happening is actually the problem. It's crazy. There's my rules for me, but Gavin Newsom can go eat at dirty laundry because the rules don't quite apply to them as much as they do to me.
Yeah, just enough time for all the hedge funds to unwind their shorts. Now it's back online. I thought that was great. Yeah, Stu, you've got this
Yes.
federal stuff's really interesting here.
It is, David. We are tracking a bunch of different stuff around the world and everything else. And Biden, with his executive orders, we're really kind of wanting your opinion and your take. We had a couple articles hit our energy news beat, and one of them was President Biden orders study on effect on ban on new drilling on federal lands and the water. And then it had I believe, a 6-month moratorium on the tribal lands. Just want to hear your take on the executive orders as they're applying to oil and gas.
Yeah, so there's a couple things to unpack. So the moratorium is 60 days on new leases and new permits. So effectively, the Department of Interior has withdrawn all the authority for BLM offices to go act on their own and push things through. So they're doing a study. I would expect at the end of that study, they will find that new leases will have much more stringent greenhouse gas study requirements, et cetera. And permits will have probably a ban of flaring. Possibly, if they're really trying to stop fossil fuels, a ban of using fresh water on fracs, and then that'll be that. The tribal piece, I think, is pretty interesting because they're basically making the point that the tribes across the United States, even though it was the Utes in every treaty matters. So, but he basically gave a blanket waiver for tribes saying you are sovereign nations, you can move these along as you see fit, because the economic value to your reservation of oil and gas development is very, very high. Now, I think this sets the stage, and we're going to see tons of lawsuits coming out over this. The federal government has already issued the leases. The operators have the right to get permits under those leases, and American citizens benefit by the use of and royalty payments of these leases. So how can you treat the tribes different than Americans? I think there's going to be some gray area here, but that's really what the 60-day moratorium was on that. The second one that Biden had said in the executive order that he is going to evaluate subsidies and cancel subsidies for oil and gas companies. Now, there are no subsidies for oil and gas companies. You can argue.
Thank you. I hate this. Sorry, I just brand. People tell you this all the time. Oh, there's subsidies. Where? Show them to me.
Well, it's the same. It's accelerated. It's accelerated depreciation. So if I drill a well today and I spend $100 on it, I can write $100 off against the income from somewhere else, instead of doing it as like a straight line production or depreciation. But the reality is, over the last 10 years, oil and gas companies have put $342 billion more into the ground than they have pulled out. So even if you were depreciating that at 10% per year, we still have tax pools to the ends of the earth. So both of the actions taken by Biden are nothing burgers that have no short-term impact. And quite frankly, they should be banning flaring, in my opinion. They should be reducing the use of fresh water. So I think that there will be lawsuits and stuff, but this will come out equitable. This is just to make the Democrat base feel like the good things are happening. I will say one more thing before we pivot from this. I find it amazing that the Democrats have been for the last year screaming at the Republicans that we don't listen to science and we need to listen to the experts. And even when experts in economics come in and statistics come in and say coronavirus is not that bad, they're like, listen to the doctor. The doctor knows what he's doing. And yet they have a whole bunch of people leading these organizations inside the White House that are now like climate change activists. They've never worked in oil and gas. They've never worked offshore. They don't have any breadth of experience. But in this particular case, we shouldn't listen to the experts because they know better. But with coronavirus, you should listen to the experts that we tell you because they have the same thing that we say. So
well, on that topic of flaring, I found this hilarious. We ran this story on Newsbeat. I think it was Wednesday, Stu, I think.
Yes.
All it was BP now has 124 flaring permits that are up against on the TRCCC. Yep. And Jim Wright, who just got elected, blasted them because about 6 months ago, BP came out and said, oh, we shouldn't have flaring. You guys are too lax on it. This stuff just cracks me up.
Yeah, it's going to be interesting. And I think ultimately flaring is a result of poor planning by companies who didn't have a good rig schedule. And if you are going to a place at One Energy and throughout my entire career, I always said I would never truck a barrel of water if produced, if I could. Never. I would always have a water pipeline unless like one was just nowhere in service, and we would never flare gas operationally. We would always tie it in. And so that was just the way we worked. So we would not drill the well until we were ready from an infrastructure standpoint, and shame on the companies that aren't prepared to do that because like, what are they doing? Yeah, shame on you, BP. Shame on you.
Yeah, it just cracks me up. It just cracked me up. So, well, I guess let's go here first. There's a couple earnings this week. We got Exxon happen this morning, so you can respond. What are you seeing? Because really it heats up next week, next 2 weeks, but we did get a couple drips and drabs. We've seen oil field service. How are earnings looking? And then you can kind of tailor into what's going on with Exxon.
Yeah, I mean, so actually this morning was Chevron. Chevron came out before the bell, and they missed. I don't know who are the analysts that thought they were going to make. Refining margins have been atrocious, and sure enough, they lost money. Upstream has not been good. So I mean, we're going to see the real effects of low oil prices on these companies, and our companies don't survive. I've been talking about it all this week. My recommendation to oil and gas companies is we have to shrug. And the shrugging is we have to manage our production levels so that we do the most efficient for the lowest cost to maximize NPV. And we let production decline another 20%. So prices in the world can go up to 65 or 70 a barrel, and gas prices can be 350 or 4. Because A, that's economic. And B, the only way we're going to make a breakthrough with people is for consumers to be mad that we're not energy independent and that it's so expensive to fill up their gas. Only then will we have a seat at the table to say that our energy is important. So earnings are going to come. They're going to all be awful. The market is forward looking, but I'm not sure the market can be forward enough looking at how bad these earnings are unless oil keeps rising.
Yeah, wow. and oil just continues to rise. Oilfield service, I thought, was interesting. They all tried to say, oh, our revenue was up 25% from quarter three. It's like, well, that's not what I'm comparing. Yeah. The worst quarter you've probably ever had was quarter three 2020. So it just cracked me up on that point.
Yeah, we'll continue to see mergers amongst the oilfield services. I do think they're going to start having some ability to raise prices, where E&P companies have gone into year end telling people how cheap they can drill, but it's so far below the cost replacement for service companies. We're going to see a change in pricing, which is just going to balance the dynamic. So more mergers coming for sure, and certainly in the oilfield services side.
Hey, David, that brings up a good question as far as M&A activity. Do you see it just in oilfield service, or are you seeing it also in E&P as well, too?
Yeah, we're going to see it. I think we're going to see accelerated across the board. At $52 oil, it's more constructive, and I think people can look at equity prices and feel better. I'll use an example. Centennial Development was a low of 25 cents. They're now back to about 250. Now, another person who might wish to buy them might have been trading at 10, and now they're trading at 18. So guys now they feel better about their share prices. They're always going to be equity for equity with no cash. But on a relative value basis, I think we're going to see some of these medium and large guys start buying the smaller guys to bolster their inventory. And one of those deals we saw this week was actually Enerplus in the Bakken took out Bruin, which was a private equity company that had bought $1.4 billion of assets from Halcon in 2017. They sold it to Enerplus for $465 of cash. Now, the interesting thing about that is reading the tea leaves, I believe it was the Bank of Montreal that had the debt for Bruin. Yep. And Bank of Montreal is also the note holder for Enerplus. So they're basically drawing on the bank line from the bank to buy the asset from the bank that already owns it. So in a way, it is kind of an equity deal because the bank is just shifting pockets and reducing G&A. I like the deal for Enerplus. I like the consolidation. I absolutely believe that the DJ and the Williston Basin and the Powder River Basin are going to see significant private to public consolidation this year, because there needs to be 1 or 2 operators max in each of those basins.
There was also an announcement yesterday, I believe it was yesterday, with Tailwater Capital and Oak 2 and 3.
Okay.
I'm not sure if you heard about that or anything else. Your thoughts on that one? If you're
is this the Oak Tree guys? The Howard Marks? Yeah, I think. I mean, Howard is known as a distressed buyer, and so if they're able to go in and buy, out creditors out. But again, we saw Extraction emerge from bankruptcy last week, and they've changed their management team and their board. So clearly, they're a totally different company, right? But there's still no one for them to sell, and creditors are better to convert all of the debt to equity, leave as much debt as they possibly can in there, and then figure something out, rather than go sell to a Howard Marks. So it's a nice idea. I don't know that it works, but good on them for stepping up with capital into the industry.
Yeah. Before we let you go here, we got to hold a new segment. We're going to call it IR Guy of the Week, because EQT coming out yesterday and coining the term responsibly sourced natural gas about took me out of my chair. One of the greatest things I've ever seen. The real question is, will natural gas become the new blood diamond?
I mean, yeah, natural gas is the cleanest form of energy. You look in Canada right now, where they're really pushing the green, and in Calgary in particular, it's snowy and sleety and cloudy and nasty. And when the wind doesn't blow and the sun doesn't come through there, you still need to heat your house. Every commercial stove in the United States that I'm aware of that makes food at restaurants uses natural gas. Like, it would be nice to hook up a propeller to your stove, but that just isn't a thing. So, I think natural gas continues to be the way of the future. And if General Motors, as they said yesterday, they want to move to a net zero car, which also means they're just planting trees to offset it, but they want to move to a net zero car by 2035, our electrical infrastructure in the United States cannot handle as many electric cars as these companies are going to pump out. That means we need more electricity, which means more natural gas.
Too many facts, David. Too many facts. Before we let you go, final thoughts. What should we be preparing for as we move into the next week?
Next week, earnings. It's going to all be earnings that are going to be horrific. I do think that we're seeing some cracks in the market and the economy. We're seeing that this is a casino royale, banana republic, where the Fed is talking about inequity in earnings and the growing wealth gap that they themselves are contributing to. A lot of guys degrossed this week. I think we could see a correction coming in the overall markets, and obviously that'll impact with earnings coming out of oil and gas. So will be a very choppy week next week.
Yeah, and we'll be ready for it. We'll really appreciate it. David, you can follow him, DRW, via hottakeoftheday.com. Check him out on LinkedIn. He's all great stuff. Got some great stuff coming up with him. We really appreciate your time, guys. And because it's a Friday, you get your hall pass. We're going to let you guys get out of here, get back to work. You can tell your boss, Tanner said you can take it off. For Stuart Turley, Michael Tanner, and DRW, we'll see you guys next week on the Energy Beat.